Hi, Lloyd here with strategies to help you keep and enjoy more of your money. Today we're looking at the perfect product for building wealth in your own private bank. You may recall from our last video, we said that in a perfect world, we could put our money into an account and it would grow and compound consistently year after year. It would be immune to market losses and to taxes, and it would earn a very competitive rate of return. And even when we were using some of it for personal or business purchases, the account would continue to grow and compound, unlike when we borrow money or save up to make purchases. So what are the attributes that would make this possible? First, we need a product that gives us consistent and predictable growth year after year. Next, we need protection from market losses. We need access to our cash without taxes and without penalties. And we need a guaranteed and competitive rate of return. But what product offers all of these? Well, let's find it. Here are three asset classes: static assets, predictable growth assets, and aggressive or speculative growth assets. While all of these have their own place, we just want the one optimal for the private banking concept. So let's narrow it down. Static growth assets like cash, checking, and savings accounts offer no real guaranteed rate of return or predictable growth, so these are out for banking. Aggressive growth assets like mutual funds, a business, and real estate aren't always protected from market losses and offer no guaranteed returns or liquidity, so they're not what we're looking for either. Predictable growth assets like bank CDs and annuities may offer safe growth, but they don't always provide penalty-free and tax-free withdrawals. So that just leaves cash value life insurance. Yeah, many people are surprised by this, but actually cash value life insurance provides just what we need for building wealth in a private bank: liquidity, safety, and guaranteed predictable growth. Now that we've identified the product, let's see who else understands the value of cash value life insurance. One hint, they're really good at making money. Right, it's banks. In fact, banks own so much cash value life insurance that there's an acronym for it: BOLI, Bank-Owned Life Insurance. So let's look at the life insurance holdings for two large banks. In 2019, the Bank of America reported having life insurance assets of $22.5 billion. Now, as you can imagine, they also own a lot of real estate. They have corporate and branch offices all over the country, as well as investment properties. So let's compare the two. In 2019, their real estate holdings were valued at $18.7 billion, $3.8 billion less than their life insurance holdings. Wells Fargo Bank also reported life insurance cash values of almost $19 billion and real estate holdings of $12.1 billion. That's $7 billion less than their life insurance holdings. So to put this into perspective, between the two banks, they have over $10 billion more in life insurance assets than they have in real estate. Now, I know that some of you may have heard never buy whole life insurance because it's a bad investment. Well, I guess banks didn't get that message. No, but really, banks understand the value of whole life insurance, and that's why they park billions of dollars there every year, even more than in real estate. They want the safe, consistent growth and the protection from market losses, as well as the tax-free liquidity and the competitive rate of return. In short, banks understand its value. Now you may be thinking, yeah, but I'm not a bank. How would that work for me as an individual or a small business owner? Well, let's take a look. In this example, we'll illustrate three individuals putting the same amount of money into three accounts over 30 years. Two are savings accounts, and one is a whole life policy. To the far left, banker number one uses bank loans to pay for purchases and then repays the loans. Here's the end result. In the center, banker number two uses his savings to make the same purchases and then just repays himself. As you can see, this works out a little better. And then to the far right, banker number three uses policy loans from a whole life policy to make the same purchases and then repays the loans. The difference is huge. There's over $183,000 more cash in the private bank at the end of 30 years. So what if you could have the same results as banker number 3? Just by keeping some of your money in a different place, a place where you still have control of it and still have access to it, it's just in a different pocket, so to speak. You see, by keeping some of our money in a private bank, that's really all we're doing, just keeping our money in a place where it can work better for us until we need it. But that's not all. The values from each of these accounts will one day pass to the account holder's family. Which account would you rather pass to your spouse or your children and grandchildren? The traditional bank account values or $500,000 more from the whole life policy? I choose that one. So remember, do what banks do and not what banks say do. Thanks for watching, and God bless.